Gary Cloud, the Fed is looking increasingly hawkish heading into the December meeting. How are you changing your portfolio, the Hennessy equity and income portfolio, with that in mind? Are you changing?
Greg, we right now have more of a flattening type bias in the portfolio. So we think that if the Fed does rates in December, at the margin, the yield curve is going to flatten, if not during the first rate hike, but shortly thereafter. So we're kind of neutral duration, but we do look for the yield curve to flatten. So we're not afraid of the Fed rate hikes.
One of the things we heard during third quarter earnings was that the strong dollar is hurting a lot of corporations, especially the multinationals, the industrials. If the Fed hikes again, it's only going to exacerbate their pain. So how hard will this hit the debt market, a lot of the companies that you have in your fund?
Yeah. I don't know that it's going to hit them that much. I mean, the Fed, chief financial officers haven't really hedged a lot of their foreign sales for a number of years. So now with the Fed rate hikes coming up there, they have to kind of approach that differently. There's no doubt that revenues and earnings have been impacted by that. It's tough to keep the margins up on the balance, and that could make it more difficult for credit. We think that it's manageable, but we also have concerns not about the first rate hike, but how far the Fed does go with raising rates. We question whether a 3.5% terminal funds rate is appropriate over the next couple of years. And if the Fed would go that far, we think we would have a very, very flat yield curve.
Well, still, corporations, they're issuing debt like crazy. October was a massive month for debt issuance. Are we going to see an overhang because of this? Because they are really inflating their balance sheets.
There has been a debt overhang. Supply has been very large this year. Credit spreads have widened out, both investment grade and high yield. And it's a little tougher to bring those credit spreads tighter with as much supply as what we've had. So truly that has been an issue.
And spreads have been widening in high yield. Is this the canary in the coal mine? Are you worried about that?
I am worried about that. And it has been more of a canary in the coal mine. Certainly the energy credits have been the most impacted by this. They've stabilized, but they haven't improved. Our view is, in the Hennessy and Equity Income Fund, you really need to have commodities and currency stabilized to have a further improvement, a much further improvement in the risk markets.
All right, and then finally, are there any names that you like in particular?
Yeah, Greg, one asset class we really like is the $25 preferred stock tickers. For example, Regions Finance, 6 3/8 preferred A, a 6% coupon, 6 3/8 coupon with a perpetual life, we think makes a lot of sense, and we own a basket of those in the fund.
All right, well, thanks a lot for coming on, Gary.
Thank you, Greg.
And thank you for watching The Street.